not joking. All my guys, them know me.
Hello guys, what's up? Welcome back again to my channel. My name is Melissa, and if you're new on this channel, please like this video, subscribe, click the notification bell, very important, so that whenever I post, you'll be the first to find out. This video is a continuation of my last video where I talked about mortgage, right? So today we're going to be talking about, is mortgage really a scam? And from time to time I get to hear people say mortgage is a scam, mortgage is a scam. As a matter of fact, my last video someone commented, I think renting is better and all that. So today we're just going to be talking about everything mortgage. To start with, what is mortgage? Mortgage is a loan that is taken out to buy a property, typically paid between 15 years to 30 years. It depends on what you want, your job, basically your finances, but most people tend to pay off their mortgages in 25 years, some less than that. Like I said, it depends on your finances, and for some people, you know, with time circumstances change, they might make more money, have better income, and they said, okay, you know what, I want to reduce my repayment to 15 years, and yes, they get it done. The only effect is that the money you would have paid in 30 years would be lesser, and at the same time your monthly payment will increase. Say for instance, you're paying £700 every month. Depending on your agreement with the bank, it could go as high as 2,000 or even 2,500 every month, because you want to pay up your mortgage quickly, if that makes sense. Now, when you get your mortgage, you're definitely going to pay interest rate, which I think is the main reason why people believe it is better to rent than get a mortgage, because you're acquiring a property of £250,000, for instance. You're not going to pay up £250,000. Sometimes it might even be double the price, and that is the reason why some people, halfway purchasing their mortgage, they tend to rent out the house or remortgage. We'll definitely come to that, but that's like the trick. People believe that when you buy a mortgage and you're in the property, is a waste of cash, it's not an investment because it's not making you money, forgetting that that property has potential of actually making you money in future. You can decide to remortgage, get some money back. You can decide to sell off the property, get some money back. You can decide to rent, a situation where the person you're renting to tends to pay up your mortgage, and you can even add extra on top it, you know, to make extra money for yourself. These are the things that people don't really talk about. They just see it as any investment that is not making you money is a waste of money and time and energy. No, yes, mortgage cannot be termed as a liquid investment because it does not give you money immediately, but it's real estate. You cannot go wrong. So back to interest rate, we have the fixed term interest rate, which is something we did. So we did our interest rate for 5 years. So for that 5 years, we're paying a particular percentage, the percentage we agreed from year one, regardless of the change in the market, whether there's inflation, there's deflation, wherever it is that is going on within the market. It has nothing to do with our interest rate because it is fixed. For our case, we were lucky because over the 5 years, interest rates have been going higher and higher and higher. People pay as high as 5%, 7%, which is outrageous, 8% interest rate. But because house has been fixed from year one, we were not bothered. We're not affected by the changes in the market. We just continued paying that particular interest rate. Now we also have the variable or adjustable interest rates, where your interest rate is totally dependent on the situation of the market. It tends to fluctuate, which is something I do not like at all. And some people tend to also do fixed interest rate for like 2 years, but we did 5 years, and trust me, the peace of mind it came with. I learned recently that banks are running away from the 5 years interest rate because it does not tend to favor them. Before we dive into this topic exhaustively, I would like to state that whether you like it or not, mortgage tends to favor the lenders way more than the borrowers. But unfortunately, there's nothing we can do about it because it's the system that we are in. At the end of the day, we all need to buy a house, except of course you have enough money to buy your house outrightly, like just pay cash and go. But if you're not able to do that, which of course like maybe like 95% of people are not able to do that in the UK, then you definitely have to get a mortgage. And whether you like it or not, it tends to favor the banks more than us. Let's say you want to purchase a house of £250,000, for instance, at a 5% interest rate for 30 years. Your total repayment will be £483,000. Now, you want to buy a house of £250,000. Now, you go to the bank, and after all the checks and everything, they tell you, oh, is 5% interest rate that you have to pay on top of this house. Because you know your finances, you know your income, you decide that you want to pay off this mortgage in 30 years. The total amount you would be paying off will be 483,000. As you can see, it has doubled the price of the house. However, like I said, interest rate tends to fluctuate. It could be lower, it could be higher. And at the same time, if you decide that, all right, I want to reduce my 30 years to 15 years, it will no longer be 483,000. Now, why do mortgages feel like scam? Number one, payments go towards interest rates way more than the actual loan balance, which of course is the principal money. And this tends to benefit banks way more than the borrowers, like I earlier said. Number two, interest accumulates over decades. I just give an instance, 30 years. Interest tends to over accumulate, which of course the bank in this case tends to make more money than us. Number three, you want a property of £250,000 at the first instance, and for 10% or £250,000 is 25k. You have your 25k. Trust me, you need more money. That's not even enough, because there are usually additional fees which you have to pay, like legal fees, for instance. Sometimes mortgage advisors say, in our case, we didn't have to pay mortgage advisor fee because we use the mortgage advisors that were provided by the estate developer. And of course, early repayment penalties. In fact, there's a whole lot of hidden fees. Some people tend to snag their house, which is a lot of money. Management of the estate, which I mentioned in my last video, I had no clue we were going to be paying. I think we pay like roughly £1,000 for the management of our estate, and so many other fees which I don't want to go about now because I've already talked about them in my previous video. You can check my description box if you want to know more about that. And at the same time, like I mentioned, adjustable rate, it can unsettle you, because when interest goes higher, your money goes higher. When interest rate goes lower, your rates go lower. So it can just be really, really unsettling. That's why I would always advocate for fixed interest rate, because to be honest, these things tend to go higher and higher and higher. Only on very and exceptional few occasions that it tends to go lower, but for the most part, they go higher. So it's just best you go for a fixed interest rate. Now, I've talked about why mortgages might feel like a scam, but then again, it feels like a scam, right? So why do people celebrate when they acquire a mortgage? Why do people go on social media and they're so excited that, yes, I bought a house, I bought a house in 2 years, I bought a house in 5 years of relocation? Why do people still celebrate this? Number one, only very few people can afford to buy a house outright. Only very, like I said, I would say maybe 5%, if not less than that. Because do you know what it means to cough out £250,000 cash? How much is your yearly income? How much is it? Well, how many percentage of people actually earn above £30,000 annually in the UK? You can take a wide guess on that. So for most people, the only way they can be a homeowner is when they get a mortgage, because they cannot afford to pay for it outrightly. Number two, unlike renting, you're just renting, the money is going, but mortgages help you to build equity over time, thus creating long-term wealth for you. You might not be like a liquid cash, liquid investment like I mentioned, but there's light at the end of the tunnel. And of course, there are exceptional cases, which is when there's a negative equity. Now, people experience low equity when the difference between their home's market value and their outstanding balance is small. In extreme cases, this can lead to negative equity, which is very, very awful. It doesn't really often occur, but then there's a possibility of that happening. And that's why I always preach buying a property in a very good environment, in a very good location. Nothing beats that. That way, your property will always be competitive because it is in a very, very strategic position. Now, what can lead to low equity? Buying with a small down payment. For instance, you deposit 5% when purchasing your home. In that case, your starting equity is low. For example, you buy a home of £250,000 and you contribute 5% of the value of that property, which is £12,500. Now, your mortgage will start at £237,500, leaving you with very little initial equity. But like I said, if you're in a very strategic position, that will help. And secondly, depend on your interest rate at the time of purchasing that property. Another reason that can lead to low equity is if there is a decline in the market. like house prices are dropping. For example, during the COVID period was a huge decline in the market. House prices were dropping, and at that point selling of house was very, very discouraging because the market value dropped significantly. So for example, you buy a house £300,000, and because of the decline in the market, your house is now worth £270,000. And if at the time you still owe the bank £280,000, you are in negative equity because you are owing the bank more than the value of your house. So that's why you have to checkmate these things before you decide to sell off your house. That is why I would always preach remortgaging. Remortgaging in this sense is, for example, let's say you have just 10% down payment. You're desperate at that point. You're reaching out to Halifax, you're reaching out to NatWest, you're reaching out to HSBC. Like in our time, we reached out to HSBC because of our visa status. At the time, we were on the tier 2 visa. HSBC said our down payment has to be 25%. We're like, we will see that one. We contacted NatWest, we contacted Barclays. The interest rate was crazy because of our visa status. So some people can be very desperate that they tend to get like interest rate for as high as 8%, 9% interest rates, really, really high. So that is why remortgaging is always the best. At some point, after a certain number of years, remortgage your house. Remortgaging means, of course, with the help of a mortgage advisor, you're checking for the best interest rate for your property, and it mustn't be with your current lender. For example, if you want to remortgage your house, we'll definitely be out there looking for better options that will benefit us. So that's why remortgaging is always encouraged. Now, another downside of acquiring a mortgage is that, especially when you announce, I just got a house on social media, most people tend to say, you're renting the property, the real owner is the bank, because if you fail to pay for your mortgage, it will be repossessed by the bank. There's a particular insurance that comes in that way. For instance, you lose your job, you have a temporary adjustment when it comes to your finances, you're off sick. To prevent the bank from repossessing your property, you tend to pay this insurance every month. That way, they help to stand in the gap when circumstances change for you. So it's not always a case of, you miss a payment in a month and immediately the bank will come repossess your property. Sometimes, even if you don't have that insurance, you miss some payment. Let's say you have a change in life, in your circumstance. It's not always brutal. Like these banks, they understand. Sometimes they give you time, 3 months, 4 months, 5 months. The only con is that when you finally settle back in, when you finally get a job or whatever, you will then now have to pay the backlog of payment that you've missed. So it's not like, when you miss a payment straight away, they come for you. No, not like that at all. When you're considering getting a mortgage, please, very important, make sure you consider your income long term. That's why they always say think very well before purchasing this property, because it could be repossessed by the bank. I think it's always stated somewhere, I can't remember, but it's only just stated somewhere. While you're in the process of buying your mortgage, they make sure you're very aware of it. Think carefully, make sure you can afford it. Don't just look at the beauty of the house. Can I afford this house? That's why some people, they live in London for so many years and they move down to the north, Yorkshire most especially, to get a house. Now, what's my final verdict? Are mortgages scam? In my opinion, mortgages are not scam, but the truth is that they are designed to keep banks rich and borrowers in debt, which in most cases are a lifetime debt. Imagine you at the age of 40 purchasing a house and then having to pay off the house in 30 years. That's like when you're in your 70s. So you're in debt. But then again, it is termed as a good debt. It is way better than owing your credit card £250,000. Oh my goodness. You may not even finish paying that up until you die because the interest rate for credit cards and loans can be way higher. So it's a debt, but then it is termed a good debt. I do not think mortgages are scam. Before you get a mortgage, number one, ask yourself, do I understand how mortgages work? Watch videos upon videos and think carefully. Number two, can I afford to pay extra to reduce interest? Number three, am I prepared for the long-term commitment? I've talked about this. As I'm talking to you now, ideally we should be in Canada, but here we are stuck because we have commitments. We have to solve all these things. If we didn't have anything in the UK, just carry your bag and go. There is that flexibility to do whatever. You want to go and live in the sky, go. When you have commitments, you have to consider all these things before you finally move. It's as though you're tied. you know, you're tied to that country until you figure out what to do to your properties. And on the flip side, renting isn't entirely throwing money away, because it gives you a lot of, you know, flexibility to do whatever you want to do, as well as financial freedom. So for me, the key is making the best decision for your lifestyle and financial situation. Let me know your opinion in the comment section. Are mortgages calm? Share your thoughts in the comment section. Would you prefer renting to actually acquiring a mortgage? Let me know in the comment section. And I also want to strongly advise that sometimes it's just best to get as much mortgages as you can and just rent them out. So when you're looking for buy to let properties, typically just go for maybe like smaller properties, less expensive properties that are maybe worth below 200,000 pounds. I'm not a financial advisor, but that's what I think. It's better than going to buy, like, for example, a 5-bedroom detached house, hoping to rent it out. How many people are actually seeking for 5-bedroom detached house to rent? Because it is very expensive. But when it comes to apartments, terraces, people are always on the lookout for that, especially 3-bedrooms. So be very strategic in your actions. And thank you guys so much for watching the video. Share your thoughts in the comment section, and I will see you all in my next one. Bye guys.